Hello. Welcome back to the channel. We have the Cortadas flowing. And today I've been thinking about the idea of escaping inflation. And there's a lot of content out there about moving countries, getting second passports, relocating to lower tax jurisdictions. And if you can do that, that's amazing. That's a legitimate path. But I think there's a version that doesn't get talked about as much. And that's kind of you don't actually have to leave your country to escape your currency. And I think that's kind of a big deal because for most people, the thing is that, you know, what's actually eroding their wealth isn't where they live, it's what they're storing their savings in. Like I grew up in South Africa. The South African Rand has lost something like 90% of its value against gold since 1994 when I was born, 31, getting old. And I mean, my parents bought their first house for what now sounds like a joke. And the thing is that they did everything right. Like they saved, they worked hard in careers for more than 30 years, but the money itself, it's kind of broken. It's you can't escape the deflation and inflation race. And that's not just in South Africa. It's the same case in Argentina and Turkey and Egypt. Even people in the US and the UK who are starting to watch their purchasing power sort of just erode year after year. So I wanted to break down 5 ways you can actually escape inflation without packing a bag and leaving your country, essentially. These aren't just theories, these are things that I've done myself or watched other successful people do. And I think once you see how this works, you kind of can't unsee it. So, number one, you can hold digital dollars or stable coins instead of a local currency. This is probably the most straightforward and easy one. So, instead of keeping your savings in a rand or pesos or lira, or whatever local currency you have, you hold digital dollars like USDC, USDT. These are tokens pegged to the US dollar that you can hold in a wallet and use all the keys you control. It's outside of a bank. And I know, some people say it's that's still dollars. Dollars inflate too. Yeah, of course they do. The dollar loses 2 to 3% a year, which is not insignificant. But if you're in a country where your currency is losing 15, 20, 30% a year, holding dollars is a massive upgrade still. It's not perfect money, it's just better money than what you currently have access to. And the thing is, the barrier isn't what it used to be. How do you get dollars? You need to have a US bank account, which is basically impossible for most countries, especially in South Africa, or you pay massive fees to hold them in some offshore structure in Switzerland. But now you can just download a wallet. You can buy USDC. You're holding a digital dollar, no permission required. There's no kind of minimum entry fee into holding it. It's just a different kind of payment and banking rails, essentially. So number two is get paid in dollars or stable coins. It's kind of a bigger deal than what people realize, I think. If you do any kind of remote work, freelancing, consulting, building software, maybe you're a graphic designer, you can structure your contracts to get paid in USDC or stable coins instead of your local currency. And I mean, this is becoming more mainstream. YouTube right now, as of this month, have just added essentially stablecoin payouts for creators. Stripe and remote.com are paying contractors in USDC, and Visa itself is also piloting stablecoin payouts for gig workers. So it's not just a fringe kind of crypto fad or trend. It's if you're looking to earn outside of a depreciating currency, essentially, this is an option. But the moment you want to kind of save in your own currency, you're still losing and stacking against inflation. Um, so essentially, giving yourself, like the opportunity to access a global currency that might be more stable than your local currency. So you can quote in USD, essentially receiving the stable coin and only convert what you need for, your monthly expenses. The rest can kind of just stay in your digital dollar wallet. So the third kind of tactic that you can use to escape inflation is an important one, and that's using Bitcoin as your long-term store of value, almost your savings account. Um, I'm not talking about trading Bitcoin or trying to time the market bottom or top. I'm just talking about using it as a place to park value that you don't need. This is a 5, 10, 20-year time horizon. It's digital capital. It's a store of your capital. The thing about Bitcoin, and this is what I think most people miss when they just look at the price volatility, is that it can't just be inflated. There's a fixed supply. There's 21 million BTC and that's it. No government, no central bank, nobody can print more Bitcoin. And if you zoom out, kind of every other 4-year period in history, it's outperformed most asset classes. like it is volatile, and I'm not gonna, pretend like it isn't. This isn't where you put your money and if you need it next month, you withdrawing it. But for long-term savings, you're still going to you're going to escape that inflation. It's a global neutral kind of digital store of value that exists outside of the fiat system. And I think the way to think about it is stable coins for spending and short-term stuff, and then Bitcoin for long-term, almost like wealth preservation. It's kind of two different tools for different time horizons. Now, moving on to number four, is price your work in USD even if you get paid locally. This one's a little bit different, but I think it actually matters a lot. If you run a business or do any kind of freelance work, you can set your prices in dollars, even if your clients end up paying you in a local currency. What this does is it kind of just automatically adjusts for inflation. When the rand drops or whatever local currency you have against the dollar, you're not constantly having to renegotiate rates or chase inflation. It feels like it's almost valuing your time on a global scale. And I've seen people do this with consulting rates, particularly like SaaS software subscriptions, even actually like physical products. But I think it's more relevant for like a more internet native business where you quote in dollars, you invoice in local currency at whatever the exchange rate is. It just protects your purchasing power without requiring your client to deal with potentially crypto, which they might be uncomfortable with on international wire. So it's not like a complete solution. It's just more of like a mental framework, like a mindset shift. You stop thinking of your work as worth a certain number in your local currency. You start thinking of it as worth a certain number of dollars. And that changes long term how you price and how you negotiate and think about your own time as a store of value. So moving on to the last one, number five, move your savings on chain and hold your own keys. This is kind of a deeper one, but it's just more about what currency you hold. It's about where you hold it and who controls it. When your money is sitting in a bank, you don't really own it. It's a number on their ledger, on their database. You have a claim on it, but the bank can freeze it. The government can restrict withdrawals. The whole system is kind of just, it's one big lockup. And like we've seen this happen in countries like Lebanon and Argentina, the Canadian trucker situation. When things get stressed, the banks become almost like a choke point and you don't have control over your capital. So, one thing to just think about and consider is when your money is on chain in a wallet where you can control your private keys, you actually own that capital. No one can freeze it without your permission. No one is going to stop you from moving it. It's yours in a way that money in a bank kind of isn't. And I think this is the part that gets underestimated. It's not just about like escaping inflation, it's about sovereign control. It's about knowing your savings. It's your capital. The value you've built is actually yours. It's not according to some bank account or local bank account that, can itself go under and become bankrupt. And this is what I talk about in terms of like on-chain rails. You don't need a second passport to have a plan B. You need a second set of almost financial infrastructure that's digital and it's more internet native. So yeah, that's kind of the five ways. Hold stable coins, get paid in dollars, save in Bitcoin long term, price your work in dollars, move money on chain, and hold your own keys. And I think that kind of ties it all together. None of it requires massive wealth or complicated, like legal fees or offshore structures. It just requires like understanding that right now your local currency is a choice. It's not an obligation. And that's the kind of shift that I think is happening right now. For the first time really ever, anyone with a phone and an internet connection can access the same monetary tools that used to only be reserved for the wealthy people. You can hold dollars, you can hold Bitcoin, you can custody your own assets, all without needing local permission. Like the digital on-chain infrastructure is there. And I think it's the right time to educate yourself on it, especially if you're an internet sort of native founder or business owner. If any of this is useful, I'm just curious what you're doing to protect your savings right now, and actually what's working for you in your specific country. And I hope you've enjoyed this latest episode, and we'll see you on the next one.